Do you hold foreign company stocks or vested RSUs? Do you know how to report your income and disclose foreign shares in your IT return? This video is for you. Watch till the end. Restricted stock units are a type of equity compensation. They are mostly provided by MNCs. In India, there is two layers of taxation for this. At grant date, you are promised a certain number of equity shares on a future date. At vesting, once the conditions are satisfied, you actually receive the equity shares promised. And this is a taxable event. And then you can either hold for some time, for appreciation, or sell them. And when you sell them, it is another taxable event. At the grant date, you are promised a certain number of equity shares with some conditions. Conditions will see later. But at the grant date, you have not been provided with any shares. So no asset held, no tax payable, no disclosure to be made. At vesting, once conditions are satisfied, you actually receive the equity shares. Fair market value of those shares on the vesting date is taxed as perquisite under salary. Your employer has to deduct TDS and provide you Form 16 or Form 130. Details of foreign asset is disclosed in Schedule FA. Table A3 is for the details of foreign equity and debt. In this, we'll enter the country, the name of the company, their address, and then the other details. Date of acquiring the interest is the vesting date. Initial value of the investment is the perquisite amount provided by your employer. That is the fair market value. Note that it should be entered in INR. If your broker says 0, no, it is not. It is the cost, that is the fair market value of the share. Peak value of investment during the period is the highest value of the share at any point during the calendar year. Note, it is the calendar year and not the financial year. Find the amount and convert it into INR. Closing balance is the value as on 31st December of the calendar year. Then the total gross amount paid or credited with respect to holding during the period is the dividend or interest received during the year, mostly dividend from the equity. Then total gross proceeds from sale or redemption, it's a sale value if you have made any sale. For converting the foreign currency amount into Indian rupee, we use the Rule 115 of the old IT rules or 206 of the new IT rules. For converting the initial value, you take the SBI TTBR as on the last date of preceding month. That for example, if the transaction is made on March 30th, then take the TTBR value of February 28th. For converting the peak value, take the SBI TTBR rate as on the particular date. For closing value, take the rate as on 31st December. For converting income received, that is dividend or interest, same way, take SBI TTBR as on the last date of preceding month. Fair market value of RSU are determined based on the Rule 3 Sub-Rule 8 of IT Rules 1962 or Rule 15 Sub-Rule 6 of IT Rules 2026. If the equity shares are listed in one stock exchange, then the fair market value is the average of opening price and closing price on that day. If the equity shares are listed on more than one stock exchange, then you take the average of opening and closing price on the stock exchange which has the highest volume of trading. If there is no trading in the shares on the stock exchange, Then the closing price of the share on the stock exchange, which has the highest volume, has to be considered, and the date must be closed and immediately preceding the date of exercising or vesting. If equity shares are not listed, then the value has to be determined by a merchant banker for the specified date. Dividends. These are taxed on normal slab rate in India. Foreign countries have different rates, and they withhold a certain percentage of your income as tax. The tax can be claimed as foreign tax credit in India. So check for DTA with the other country. You need to file Form 67 or Form 44 in New Act separately, providing the withholding details, mention the article before filing IT return. In IT return, Schedule OS should have dividend income, Schedule FSI should have the details of foreign income and the tax relief, and then Schedule TR should have the summary of tax relief gain. The next taxable event is the capital gain. That is when you sell the shares. The cost of acquisition for those shares shall be the fair market value on the vesting date, which was actually taxed as perquisite. Selling price should be converted into INR using SBI's TTBR on the last date of the month, immediately preceding the month. And all these details are entered in Schedule CG. Since foreign shares are traded as unlisted shares in India, the holding period shall be determined based on 24 months or 720 days. If you hold these shares for more than 720 days, then it becomes long term. If you hold it for 720 days or less than 720 days, it is short term. So long term is taxed at 12.5%, then short term is taxed at slab rate. Vesting period is the time an employee works in the company before receiving the stock compensation. This condition can be time-based or milestone-based or a combination of both. Time-based conditions can be immediate or graded or cliff. In immediate vesting, the employees receive RSUs immediately upon accepting the grant. In graded vesting, employees receive RSUs partly over the years, generally 3 or 5 years. In first year, they receive 20% and the next 20 or 30 and so on. In cliff vesting, the employees receive RSUs after a waiting period, generally 1 year. If they leave the organization before completing the waiting period, then they basically receive none of the benefits. In milestone-based vesting, employees receive once reaching a milestone, achieving a milestone. In hybrid vesting, employees need to fulfill both time-based metric and achieve a particular milestone. Some tips to follow. Taxable events, once at vesting, periodically dividends, next at sale. Disclosure in Schedule FA is for calendar year, from vesting till sale. Income is taxed on financial year basis. In graded vesting, shares are issued at various years. So keep track of each set of fair market value, sale price, holding period, and report accordingly. Use FIFO method to track capital gain. To convert the Forex into INR, use SBI TTBR. If you have unvested shares, then no disclosure is required. Collect tax withheld form for your foreign tax, especially on dividend, to claim foreign tax credit. Well, fair market value is equal to the perquisite, which is the cost on sale, and that is not zero. Hope this video is useful for you. Please like, share, subscribe to this channel, watch our other videos. Thank you.